Good morning, everybody. Rob Barnes with Integrated Insurance Consulting. Today's topic is term insurance, details that matter. We're going to get right into the material. What we're going to discuss today is that there's more to term than price alone. We'll discuss how consumers shop for their term. We'll share creative designs and some tips and tools. Now, we've all made purchases out there before, and we know that price and quality are often at the other ends of the continuum. They don't necessarily go hand in hand, and the same thing is true with term insurance. The problem is it's just harder to understand or see what the quality term means. So when we're discussing it, it really deals with quality of carrier, the flexibility of the product, and the riders and features in the product. And I'm going to dive into each one of these separately for us. So when I talk about quality, to me, it starts with the financials and ratings of the carrier. There's no reason to use inferior carriers out there these days. There's a lot of life insurance companies, and we certainly, the better rated you are, the more we appreciate it. I look at historical performance. Is this a company that just decided one day to be competitive in term insurance? Have they always been? What's their product portfolio? Do they offer a comprehensive portfolio of life insurance products, or are they simply a term specialty carrier or somewhere in between? Those things can matter, as you'll see. And then carrier reputation. As financial planners, you might not have a well enough insight for this, but being in the industry for 30 years and working with a lot of carriers, we certainly understand the good, bad, and ugly out there. And of course, we stay away from the ugly and use the bad as rarely as we have to. But carrier reputation matters. And personally, I can tell you that we have our favorites for all the right reasons. And it's hard to be a competitive company out there in today's environment, no doubt about it. When we think about the flexibility of a term product, we want to know what happens after the lock-in period. This is an important feature which we'll share. And knowing whether or not they allow conversions and what options do they allow or what limitations do they restrict in the policy. And believe it or not, there's a lot of term policies that don't even allow you to reduce the face amount. And so these are questions and design features to discuss with clients as to what kind of term policy is going to fit the best for their situation. So normally, there's three options for what's going to happen to a term policy after the lock-in period. It's either going to expire or terminate, or more and more, we're seeing death benefit reductions after the rate lock period. But the most common option is to turn into annual renewable term, or ART, as we like our acronyms in the insurance business. And so let's take a look at a 40-year-old female. She has a premium on her 20-year term of $620. And the very next year, year 21, that premium's going to jump up to $11,000 a year. Excuse me. So what I want you to imagine is the other features or the situation to the client. If the client just found out in the 19th year that she has a terminal illness and isn't expected to be around for long, she'll find a way to pay that $11,000 premium because her family will still want the death benefit. But what if she's in a product where the death benefit reduces? So in this case, in year 21, the death benefit goes down from $1 million to $329,000 and continues to lower from there. And here's the important part about convertibility with policies. If this policy had no conversion option, this lady would be stuck. Now, I know that I'm giving you a rare situation of somebody with a terminal illness, but the more likely scenario is over the 20 years, this female contracts some condition or disease that limits her insurability or makes her uninsurable with it. And so if now the policy is more valuable than ever, but if the face amount like this goes down, that could be a bad situation. And so we're actually going to show a real world situation near the end of the program where this happened. And the good part of that story simply is that the business owners made a wise decision and bought quality term that had options and flexibility to it. So when we talk about converting, we want to know how long we can convert for. What options do they allow for conversions? What limitations do they restrict you with? These all can come into play and be important down the road. And so knowing this stuff up front and asking the right questions to design and pick the right carrier and product is key here. So what we look for is a conversion option that doesn't select against the client. We want them to be able to buy any product that the carrier sells, not a special product, if you will. And we want that convertibility as long as we can get it. Now, in the insurance world, generally speaking, age 70 is probably the most, on average, it's the norm what we see with carriers. Some have age 65 and others go as late as age 75. The limitations that you see on term policies these days, you might have a 20-year term policy, you might have a 30-year term policy that only allows you to convert for the first 20 years. So if anything happens to their health during the next 10 years, they'll have limited options and flexibility moving forward. And some carriers, this is happening more and more, they require you to add a rider to be able to convert the policy longer. So in my example here, the 15-year term that's only convertible for 10, if you add their extension rider, then you'll have the full 15 years to convert the policy. And so again, looking at it in a chart, and in a minute, we'll share some numbers with you to give you more insight to the importance here. But quality convertible term is with fewer carriers out in the marketplace, and it's harder to see if you don't know what you're looking for. But again, what carriers do, I'm going to start from the bottom up here. So the most restrictive would be there's no convertibility allowed. So we've seen some carriers that do have quality conversion term, but they came out with a cheaper term product that doesn't allow convertibility. Now, I've been around a long time. I have all kinds of stories to tell you. We're here to get you and your client what they want to have, but it takes some education here. But I'd rather have some conversion option versus none, and I'd rather have the best conversion option that allows me full flexibility and choice so I don't get hosed by the company later, if you will. So what we see is carriers, so carrier one is our quality conversion carrier here. So if this lady found out in the 19th year of her 20-year term that she now has MS and or other conditions or diseases that shorten her lifespan and so forth, make her policy more worthwhile, she could convert and we could guarantee the policy to age 100 with a $15,000 premium. Now, carrier two, they have a better conversion option in the first 5 years, but after that, it's substantially higher and it's not fully guaranteed. And then you can see carrier three, they have a conversion option at 21,000. That's better than 28 and no guarantees, but it's certainly not as good as the 15,000. And so what I've done here is put the term price underneath each of these. And for $100 more, your client can have quality term with more flexibility and options down the road, which might matter because planning doesn't always go as the software tells us, right? Stuff happens and things change in life, and that's the value and the virtue of a quality convertibility. So, excuse me. So the other thing, and this is something that some smaller carriers do, Your client buys a 30-year term for $3 million, and then 15 years in, they want to lower the face amount, and they find out through the School of Hard Knocks that they can't reduce the face amount. So these, again, questions to start with. Start with the end in mind, as Stephen Covey tells us. So what I look for in asking and designing policies is we want a carrier that contractually allows you to reduce the face amount. I can handle some restrictions, but what I don't want is somebody that doesn't allow it at all contractually, or as a business practice. It's not in the contract, but they might reduce the face amount if you ask them. Again, if we knew that somebody wants to reduce the face amount, we need to account for that and be with the right carrier or design things differently, as we'll cover with our unique designs a little bit later in the presentation. So these contractual face amounts, they come in the flavor of, they'll allow a certain reduction, a percentage of the death benefit, but not all the way down to the minimum. They'll allow it with certain policy years, or a combination. The maximum you can decrease things in the first 5 years is 35%, as an example. And that comes from one of our carriers, quite frankly. So beginning with the end in mind, do you want the ability to carry coverage longer? Do you want the ability to reduce coverage later? Do you want the ability to convert coverage later? Or are you just looking for the cheapest option? Those are important things to know. So I have to admit that we don't, I often am just implementing your recommendation, but when I produce a list of carriers and pricing after we've screened somebody's health, we have to educate them on what these things mean. And I find that when clients learn more, they often will want some of their term to be quality, is the reality of it. So today, carriers, again, they've stripped down policy features to be cheaper, to appear lower on the price grid that we might make for them, because they're aware that a lot of people are working on price only in their minds. And so a number of carriers have gone to adding this conversion extension rider. Again, back to the earlier page, our 30-year term is convertible for 20 years. But if you add the extension rider, it'll be the whole 30 years or age 70, whichever happens first, as an example. Waiver of premium is kind of a built-in disability to pay the term premium. I know some career agents are taught to add this to everything, and there's certainly value to these things, especially at some carriers and the way those work. But if somebody has good disability insurance and savings and so forth, I don't worry about this as much. And the waiver premium that is offered by many carriers is not the comprehensive one that it can be at some better quality carriers. But again, if they have good disability, they can still pay their premiums, is the reality of it if they become disabled. But it is something you can add. In fact, when we're working with people who can't get more disability, or sometimes blue collar individuals are limited on their disability, so adding waiver to their term might make more sense, there is the reality. Spousal riders and children term riders, again, unless you've delivered that your client wants a policy and wants to insure the kids, we generally don't touch these things. We get the best insurance for them. And these two things, accelerated benefits, living benefits in a term policy, and this chronic illness conversion, I want to spend a little bit of time on both of these to tell you that there's more to term than it might appear, and that living benefits are things like critical illness riders. Think of your Aflac duck here on commercials that you see, some critical event happens to you. And for some people, being able to collect some money off of their life insurance might be a godsend at that point in time when calamity strikes. Some policies have some chronic illness availability. This is long-term care stuff here, right? If you're unable to perform 2 of the 6 ADLs, you might be able to take some money off of your death benefit to help out in a time of need. And then terminal illness, almost every policy I'm aware of has these. This is what put the viaticals out of business. But if somebody's terminally ill, you want to spend the rest of your life working, or maybe you want to access some money and go to Hawaii with the family and spend your days in peace so you can take some of your death benefit in advance of dying. Now, when I talk about these benefits, it's important to know what the pricing might be. And so what I have here, the carriers A, B, and C are, and you can see how competitive we have three carriers with exactly the same pricing, but they are three different carriers, I assure you. But in our price here, Company D and Company E are companies with these inclusive chronic and or critical illness riders to them. And then company F is unique. That's the CICA. I'm going to come to that for a second, but to better understand, so we have a company here that's the same price as the ones above it that have these inclusive riders. But what I want you to know about them, I call them inbred riders. And I use that because I want to, acknowledge that they're different. There's something with them. They're not a dollar for dollar reduction of the death benefit. So as an example, if somebody had $1 million death benefit and they're deemed eligible for 250,000 of their death benefit because some chronic or critical event happened, the carrier is often going to hand them a check that's substantially lower than that 250. So they might write you a check for 100 grand, and your death benefit remaining is not 900,000, it's 750. So there's a cost to the rider, not as much up front, but on the tail end, right? Which is fine. And you don't have to take the money, but for some people, that might be a vital thing for them to have. Again, with certain client situations, I prefer one company over another, knowing, again, in the blue collar world, knowing that a lot of manual labor people don't get good DI and usually don't have as much reserves and such as other people. These kind of policies can be very advantageous for them to have. And when everybody else is asking for money in time of need, we'll be able to deliver some money to them if they have these riders. Now, this last one, the one in yellow, the Company F, this is a little bit different. This only has benefits for chronic illness, not critical illness. And, I was recently at the NAPA convention, and I was sitting in on a long-term care presentation. Again, that's our next presentation to you guys next month. But somebody in the crowd had asked, I have younger people. What can I do with my 40-year-old to lock in something for long-term care? Because there's not really a lot of products at younger ages. And clients aren't really ready to talk about becoming chronically ill someday when they're younger and more invincible. But this is the best way that I know that somebody can lock in their insurability to have a quality long-term care product later in life. And so let me go through this. I use an example of a car crash, right? And so the 40-year-old female buys this product. She spends a couple $100 more than she could have in there, but she's not only locking in a quality convertible term product, she has a rider that will be automatically included. And so in 5 years, if she's in that car crash and she's disabled from the neck down, not only is she unable to work, but she needs help, right? So what would go on with this policy is she would convert the policy from term to perm. She's guaranteed to add the chronic illness arrangement rider to the policy. And then we would be sending 2% every month of the policy death benefit to her in full. There's no discounting on this one. It's a dollar for dollar reduction from the death benefit. We would be sending 2% of the death benefit monthly for her care until the full $1 million goes out. Now, again, I recognize that a car crash and a calamity like that is a rare situation, but they happen. What's more likely to happen is between age 40 and age 60, when she's honing in on retirement, she gets that MS diagnosis or Parkinson's or you name the condition. She's not going out and buying long-term care at that time. She'd be a decline across the industry, with rare exception. To the good products, I should say. She wouldn't have any good products available. But with this product, she could simply convert any part of the $1 million term she had, add the chronic illness rider to it, and it's all just paperwork. There's no underwriting to it, so she could go into it. Now, in 20 years, if the client's healthy, wants to buy any long-term care product that she cares to have, she can go out and do that. And what we could say is we could look back and say, okay, well, you overpaid for your term insurance the last 20 years a little bit. But that's hindsight, and we don't have hindsight today to know what's going to be the future for her. So, if you came in a few minutes late, I just want to emphasize, please log in 50 minutes. We do track you here, and we will have a 10-minute Q&A as well at the end. Load your questions into the Q&A box. When you end the call, there's a survey. Please include your CFP code. We appreciate you filling in the full survey, I should say, but at least fill in your CFP code, or let us know if you're not a CFP. And if you have to leave the meeting leave your desk right after the meeting, in 24 hours, you'll get a repeat email of that survey. So if you can't fill it in today, you have an opportunity tomorrow. We appreciate all your feedback to know what you want to hear from us next. And so let's go on with how consumers shop for their life insurance these days. A few years ago, a milestone was hit where there's more group life insurance in force than individual. You can get solicited on the phone, radio, and so forth. You could buy from a career agent or an individual direct-to-consumer company. You can certainly buy off the internet or the 1-800 Buy Your Life Insurance, but we sit in the insurance broker situation. So I want to address each one of these, both pro and con, to have you better understand the term world. So a lot of people think that group life insurance is buying in bulk and some special deal because everybody gets it and so forth. And the reality is that's not how it works. Because they're doing no underwriting, the unhealthy people are being subsidized by the healthy people in the group. And if you don't notice it right out of the gate, over time, it will often be a more expensive product. The younger you are and the healthier you are, the more that's true. And you're also locked into often no portability of the product, no convertibility, or very unattractive options, but they don't price group for you to keep it and take it with you, generally speaking. So what you need to do here is some math. And when we look at group, it's often banded in 5-year age groups. And here we did the math for a 45-year-old male. So we looked at the ranges of 45 to 49, and we added up what the premium is for each of the bands. And over 20 years, this male would spend $52,000 out of his pocket, or have an average monthly premium of $217. So if we go to a fully underwritten product, even if he's just standard non-smoker, let alone preferred pricing, we're at $85. Again, he's got a lot more benefit than this in reality. He's got portability, usually convertibility. I might add some of those extra rider benefits that we discuss with critical and chronic illness, but I don't have to do the math here beyond this. If he's standard or better, I not only have a better price and product today, it's definitely better over time. And so what often happens is nobody's doing the math, nobody's asking the client, or nobody wants to take time. But this is the issue with having group coverage. In fact, I have a young lady who, it's a longer story, but 3 years ago, we placed some term on her. We found out she had a lot of group term, and she wasn't ready to replace that. We reached out last year to do that with her, and she ignored all that. And she comes to me literally last week saying, I was just put out of work. And here's, at least in her case, she has some ability to take the product with her, but we've already done the math. She's much better buying her own policy, is the reality. And not only are we going to improve her options and convertibility, we can add some of those riders that we spoke of to make it a more comprehensive product. So we'll include an integrated insight discussing this a little bit more and showing you the math so you can be aware of it. Now, solicitations, these come often with has-been celebrities that are marketing this stuff on radio, TV, whatever. But again, these are not generally quality products in there, but they serve a place in the marketplace. If anything, they're convenient, right? To be able to just ask a few questions, answer a few questions, and get some insurance. But this is an example. I've been a AAA member. I keep questioning that every year I pay my bill, but they send me these solicitations a few times a year. And note that I can just answer no to these 3 questions and they'll probably insure me. Well, what they're missing is they don't ask if I'm a raging alcoholic. I'm not, but there's a lot of things they don't ask or underwrite for. And therefore, the people that are unhealthy, they have to pay for that some way. And so the healthier you are, the more likely you're subsidizing them. And although I'm no longer 45 years old, we just pulled this one out that note that the rate would be $56 a month to start with. But even if this person's just a standard rated person, they're $42 a month. And if they're preferred, they're half that price. So this is the difference between some of these simplified issue products and the difference of buying quality term. So moving on to a career agent or a direct to carrier, a single carrier soliciting coverage. I have no problem. In fact, I work with some career company people that are not captive. So when their mother company doesn't work, they'll come to us because we're a brokerage shop. And so the problem that they have is they have one product, they have one underwriting opinion, and they don't have a plan B, especially if they're a captive agent. So starting off with us, screening and so forth, we just have a lot more to offer is the long and short of it. And I do have a pricing of a career company, and that's a quality product. So I consider that a competitive premium there at $745 and $1305 for it. They have good convertibility, good permanent products at that career company. And then you'll see I put some X's under the no agent, no commission stuff. Now this is still evolving, and the bottom line with the life insurance industry and the commission-free world, first of all, commissions are just part of the distribution process. Like it or not, it's just reality. And the 2 companies that are priced here and X'd out are no longer offering commission-free insurance. One of them is TIAA-CREF, and the other was Haven Life, a wholly owned subsidiary by the Mass Mutual. And they both went out of business. Now, I think there's one company that has a brand name that started offering commission free, and they're available at one source that I'm aware of, but I don't know the details for sure. But I want to keep a pulse on this, certainly. But even if that is a commission free, and if they're, because this is a carrier we have in our arsenal, if their price is cheaper through them, I question how those people are getting paid to work and issue the insurance and so forth. But I don't know that there's a big price difference or any price difference between our product and what they offer there. And if they do, again, it's just the only company that I know. So if you go there and the underwriting didn't work out for you, there is no plan B at that organization. So we can still keep a pulse on this, understand that people hate commissions, but again, you can still do this business right and work on commission is the reality of it. Just see enough people, it all works out. I've been doing it for a long time, but we do certainly keep a pulse on the commission-free marketplace out in the world. So let's turn over to the internet and look at how consumers shop there. Now, On my website, I could easily have a quote engine if I want to. And I work with several quote engines from different organizations with the brokerage shop that I'm part of. And what I want to address here is just the what goes on versus what's reality. That when Clark goes on the internet, the Man of Steel is great and he gets a premium quoted of 577. But then Clark gets to underwriting and we find out he's not the Man of Steel, he's rubber coated steel. And he didn't maybe put in his exact weight on this one, and then we find out that the premium's substantially higher. And Linda, same thing. When they go on the internet and price these things, these systems often have nominal questions to guide you to the exact rate class. And then again, people fudge things. And so Linda, instead of putting her actual weight, she just started a diet and she put in her goal weight, and she forgot to mention that she smokes a few cigarettes when she's out with the girls at parties. And the difference is substantial, as you can see. So you'll see in a minute, this is why pre-screening is the first step of our process, and we do a thorough pre-screen for all kinds of reasons. So the 1-800 buy your life insurance stuff, if you have a healthy client, a younger client, they might do a good job, but you're dealing with a contract here. I don't think I want to talk to some people at the other end of the 800 number, and I'm inferring that they don't stay around long and so forth. They're not tenured as we are here, but discussing beneficiary arrangements or the legal language. How should I own my policy? What's pro and con of it? They have limited ability to shop cases as we do. And I'm neither an attorney nor an accountant, but you have to know your stuff when you're consulting with clients and knowing where to buy. Somebody I'm working with right now, he has a client who wants $20 million of coverage. I go, great. Client must be doing well. Where's he going to own that coverage? Well, I don't know. I didn't ask that. I go, well, that's the first thing I want to know is what are we doing? Because we don't want to do harm, right? So that might belong in a trust or might be a business arrangement. We'll be finding out. So as an insurance broker, what I want you to know is I've only been serving advisors and their clients for 25 plus years. We are not exclusive to the fee-only community, but we ran into fee-only advisors. And the reality was agents were becoming advisors, advisors were becoming fiduciaries. And we're here to help you no matter where you're at in that stage. And so where we differ is I'm on staff at an insurance brokerage operation with a lot of carriers and a lot of resources to it. I have 2 underwriters on staff. And we're multi-line. Now, that might not seem a lot, but especially in the world of long-term care insurance, that I can add riders to life insurance, to disability policies. We have annuities that have long-term care benefits to them and stuff. So when you're dealing with a problem of, hey, we'd like to do this, here's our situation, and now I'm going to find the right mousetrap for you, it's good to have a broader spectrum of products and the ability to work the market for on behalf of your clients. So when we have clients with health problems, my statement to people is, hey, look, we're going to screen your health. We're going to find the company to start with, but sometimes where we start isn't where we end up for your benefit. Once I get all the stuff in, your medical records and so forth, we now can start talking with underwriters. So we start our process with pre-screening. We do a very thorough pre-screen. We then go to educate and design. This is where we let your clients understand the difference between cheap term and quality term and term with some inclusive riders and so forth. We're here to get them whatever it is they want. I have no hidden agenda, but we have a lot of ammunition, and it's sometimes artwork or science or a combination to get the right fit for people. And that's what we're here to do. Is it isn't what I care. I have favorites. I have thoughts and suggestions suggestions and all that, but if you send your client here and we just want some cheap term and we don't care, we're going to get them the best cheap term we can get them, if you will. We don't call it cheap term to clients, so we deliver three options called strictly term, quality term, and term with more, and then we start explaining that. So we pull a few off the spreadsheet and help them understand. Then we get the application during the underwriting process. And if you haven't worked with us before, once everything's in place in good order or whatever, we share a kit, including a copy of the policy, the source illustration, and an IIC summary page for this. So when you look at all the places you could be sending your clients, hopefully you think that an insurance broker might do a better job for them, especially if it's a more involved case. So let's go over to creative designs here: layering or longer duration term, adjustable term, term alternatives, temporary perm, and trust alternatives. We'll look at each one of these. So earlier I mentioned that sometimes carriers don't let you reduce the face amount. And so if we know going into a situation, and if we don't know, we ask, if are you going to want to reduce this face amount down the road? We need to match you with a carrier that allows that to happen. And so in this case with Jill, we showed a 30-year term for $3 million, but we ended up layering term because the expectation, she's a doctor doing well, and so we knew that some need will be alleviated down the road. And in this case, what we wanted to do here, we saved her money, right? The 1900 versus 28, but there was a cost savings. We diversified our coverage. Our longest duration term was our best product with convertibility to it by her design. And this helps us overcome the plan designs of face reductions. Now, term insurance comes in longer flavors, and there's permanent policies that really are permanent term when you understand them better. And so there are a few carriers that sell 35 and 40-year term, but in the permanent world, I can design a policy to go to age X or year Y, depending on the need at hand. So one example, Hero was somebody that age 71, he wanted 20-year term, but at his age, 15-year term was the longest available. We were able to strip down a UL product, a GUL product, and we gave him a 20-year guarantee on the price at $14,600. We did show a 25-year guarantee, but he was doing some business maneuvering, shedding some wealth and continuity of the business to the kids, and he just wanted the coverage for the 20 years, not less, not more, and we were able to do that. Now, sometimes you're looking, so this was another business situation. They had a plan that said you had to have coverage to age 70. Certainly, term comes in flavors of 10, 15, 20, and so forth. But there's a couple carriers that offer anywhere we want in between there. And so we were able to save them some money by going with exactly the years that we need to get each one of them to age 70. And so instead of the $6,100 premium, we were able to come in at $5,300, and they had a $15,000 savings over those years. Now, this gets a little bit messy here, so bear with me, but this is temporary permanent, to have a play on words here. But this is where it's not logical, but it is in the products and the availability that sometimes a permanent policy is going to be cheaper than a term policy. And so here's an example of somebody who wanted 20-year term at age 60, right? Now, I mentioned earlier that most term only allows convertibility at age 70. There's a few carriers that go to 75. So understand, at the end of the 20 years, this guy doesn't have any option other than what the policy turns into, which is usually that annual renewable term at the end. So it'll be a substantially higher premium and step up each year. So over 20 years, his outlay is $43,000. And I just note here, I have $2,500 over here for a quality term that would be convertible to age 75. This would be my next best thing, or my counter offer to, here's cheaper term, here's quality term that gives you at least 15 years to decide if you want it longer than you first thought. But moving on to permanent policy A, this is a universal policy. It's guaranteed for a number of years, and the premium's higher, of course, at 4,000. But in 20 years, excuse me, in 20 years, you can bail out of this policy and get half of your money back. So that comes out a little bit less than what we would have done on term. I'm not counting time value of money, just dollar for dollar here. And note on the right-hand side, if this person wanted return of premium term for $7,800 a year, that would be nuts, because option B is a permanent policy that gives 100% return of your premium at some point. So it costs more than option A, or certainly the term itself, but at the end of the 20 years, you can surrender and get your full premium back for this. But here's the thing that I want to plant. Life insurance, a life insurance conversation is different than any other insurance conversation in the marketplace, because death is not an if. And so as much as the plan is, we won't need life insurance someday because the house will be paid off, I'll be retired, I'll have a gazillion dollars and all that. Stuff happens and things change. And so let's look at these three options with the thought that coming up on 20 years, this 60-year-old decided they want to keep coverage for 5 more years, right? In this situation, you see the annual renewable term is high. Permanent policy A would maintain the same premium. The premium would step up to $9,100 a year so it'd more than double for the next 5 years to keep it in force. But that option B policy, that premium remains the same. So you want to keep it longer, it's the same premium in the design. And so when I look after 25 years, I had lower premiums than the term for both the permanent A or B option. But let's go 5 more years. In 25 years, he decides he wants to keep coverage longer. Again, you're chasing annual renewable term here, and you don't have a choice. With policy A, I'd have to step up funding With policy A, I'd have to step up funding again. With policy B, it's the same 5,100. So when I look at a 30-year net out of pocket, it's lower with what started to be the highest price coverage, right? This was 5,100 versus 2,000 and some change, or 4,000 and some change for the other options. So sometimes these things make more sense if only you knew about them, or if your client knew about them. And that's why we try to help for the situation. And I like to include flexibility and plan Bs in planning, because I've been around a long time. Things don't always go smooth. And one thing that we might differ on is that I like to I like to make sure that they understand what they're getting, and think about the fact that what if you're not on pace and you still want coverage? The word need versus value is often what I run up against. Somebody might not need life insurance, but they might value still keeping it for all kinds of reasons, even though they're retired, even though they have a pile of money, and so forth. So anyway, the trust alternative. Real quick here, every life insurance policy that's sold has the ability to pay out other than a lump sum. Some carriers allow you to design that when you're writing the policy. And so in this situation for this 55-year-old, if I wanted to pay out the money over time instead of a lump sum, I can save a substantial amount of premium. Since most people live past the term period anyway, these might be good things to do. But you sometimes have a problem child, a spendthrift child, a disabled child, whatever, and instead of having to set up a trust and operate it or everything, we can just have Bill buy life insurance that guarantees a payout for the 30 years after he dies. So as long as he dies within the 30 years that he's protected, to be clear. And this is something you could do in policies that people aren't necessarily aware of. So let me go back to, when you see orange here, these are real world situations where we know most of the information, or all of it in this case. I was sent in about 15 years ago to get some coverage on these two business owners. They were starting their continuity planning. It gets to a longer story. At the end of the day, they did agree to buy quality term, but they weren't sure if they were selling the company and all those things, if the next generation was coming into it and so forth. So they bought 10-year term. And we diversified because it was a considerable amount of coverage. So we bought half of one policy, half with another carrier. And it happened to be that one policy was an ART afterwards, and the other one reduces the death benefit afterwards. And so what we were looking at, excuse me, I forgot one vital point. In year 5, one of the partners was diagnosed with a life-shortening disease, and that changed everything. And now we had to, keep tabs with them each year. Is he still alive? Is he still? And as we were creeping up on the 10th year of their 10-year term, we had to make a decision. And so the decision was simple. We want this coverage in force because he's not going to be around as long as we first thought, and we want to collect the death benefit. So option for policy A, this was an annual renewable term. You can see the premiums for the 11th and onwards thing. Now this one we didn't have to convert because he could have paid the bigger premiums, but note what we did here. We converted to permanent, and the premium was lower than what the term is, and substantially lower. And that's just because we funded the policy for a certain period of time. We figured that there's no way he's going to be here in 10 more years. And so that's the funding that we were on. And for policy B, it was vital that he had a conversion option in this policy. Otherwise, the family would have given up 90% of this death benefit when the policy reduced afterwards. So this one had to be converted to maintain the $7.5 million. And just the way the policy worked, it ended up, we kind of advance funded for 5 years to make it last the whole 10. Again, he did pass, and these claims were paid, and he passed 4 years into the conversion stuff. So he had a 10-year term. We converted in that 10th year, and 4 years later he did pass. And so these are few and far between, but they're real life stories out there. So if you have questions, add them to the question box. I'm going to run through our last section here even faster than I've been talking here just to get it in. But we understand that managing expectations, both yours and your clients, are important. Again, I've only been working with advisors and their clients, so we understand concierge service around here, and we want to screen your health to get it right the first time, to understand what we're dealing with, and not come back with a premium 3 times higher than what we saw just because we didn't ask the right question. So do you know there's carriers that at certain ages and above, if you haven't seen your doctor in the last 12 months or 2 years to get a physical, they won't issue you insurance? You know that the difference of super preferred and preferred is often stuff to do with your family, maybe not even your health, or your moving violations. How can moving violations affect whether you're super preferred or not? Well, you can have some of that scenario in mind, that you're a crazy driver or speeding all the time, you're more likely to die. But these things that you see on the board, obesity, cigars, marijuana, especially lately, that's an ever-changing. So I have carriers that will decline your client. I have carriers that'll issue your client super preferred, depending on their usage and all those things and stuff. So these are questions to ask. There are also questions to know. There is a vibrant, accelerated underwriting program out there where you can buy significant amounts of insurance without doing the typical blood or urine. As part of our pre-screening, we're also screening to see, is an accelerated program available to you? Because what we don't want to do is go with an accelerated, get declined, or get requested to do all the underwriting, and then we've already got off track and so forth. And it's anyway, we try to get it right the first time. Sometimes that's impossible to do, to be quite clear, no matter what pre-screening. Sometimes we save lives, if I can be so bold, because we find something going on in your client that they didn't even know about at that time. So we suggest that you replace or supplement group coverage when appropriate, when the numbers work. Understand what ownership and beneficiary arrangements are going on. We can help with that. Look at the policy details when you're reviewing term insurance. Is it with a participating company where they get dividends, or is it a return of premium term, or some term is not even term? It's a UL chassis that looks like term on stage one, and it could be around. This is like those options A and B that we talked about a little. And sometimes a life settlement is in place that instead of just lapsing a term, you could sell this and get some money. We believe in upgrading coverage, extend it out, increase it, or add benefits, but we do track expiration and conversion dates. And you might be surprised, but 9 years from now, we reach out to you and say, hey, Joe, we wrote your client 9 years ago. They've got 1 year left of their policy. Do they want coverage longer, and so forth? And it's important to know that before that 11th year bill gets to you. So we'll be sharing a quality term video. This article that we wrote for NAPFA a few years back talking about the issue that it's harder to understand what quality term is and fewer people have it. Here's a quote sheet for $1 million. I don't quote super preferred pricing on there just to be conservative, but if you're looking to plug a number in, you can use this grid to interpolate and add it to your plan. And this is a piece we share with clients when we show those three options. So we want to help them help us design what it is they want. I have no hidden agenda. If they want the apple, the orange, the banana, I'm here to get them the best apple, orange, or banana they want. And so in summary, and as I breathe, hopefully I've shown you that there's more to term than price. Begin with the end in mind, ask additional questions here, supplement or replace group term when available and when in the client's best interest, of course. I've shown some unique term policies, design and riders, and talked about where you're shopping. Who knows this at the other end of the 800 number, that you could actually have a better price with permanent coverage than term. This is just understanding the industry, but we're here to manage expectations, again, both yours and your clients. And we hope that you choose to work with a life expert with unique access and a proven process. So with that, I am going to look to see if we have any questions. Again, we appreciate you filling in the full survey when you log off. If you came in late, hang around, please, for the full hour to get more in, and give me a second for this. So, two good questions here. I think we answered the one about the CFP. You can add that to the survey, please, and appreciate the full survey. And again, if you can't do that now, you'll get that email in 24 hours. So you can either pay attention then or ignore it tomorrow. Somebody's asking, is accelerated underwriting more expensive? Generally speaking, the answer is no. What carriers have learned is that there are ways to see a person's health and conscientiousness and stuff. They can check the prescription bureau, the medical information bureau. They check your credit scores. I don't know if you've ever heard of LexisNexis that does some stuff out there about quality, and we're all being monitored and rated and so forth. So some of those programs, the negative that I would tell you about some programs is what I've seen is that some clients where I've screened them for the best rate class, and we go through an accelerated underwriting, and they only get the second best rate class instead of the best. Now, some carriers don't move on that. They won't let you go through and do full-blown underwriting. And we've learned to tell clients, this could happen. So if you don't have to do accelerated, we can do blood and urine, but a double-edged sword, right? If I do blood and urine, and we find something that you didn't even know is brewing in there, that could disrupt things. So all things equal, everybody likes accelerated underwriting, but again, it's the screening to tell us that you're even eligible and which program you're eligible for, because we have a host of carriers that offer that. So good question there. The next one, I appreciate this. What's the Goodman rule? So again, life insurance is a contract, right? And you get into legal stuff. The Goodman rule is when there's three parties to a contract. The typical situation that I see most often is the owner of a company had his company buy a policy on him. The company owns the policy. The owner is the insured. and the owner's spouse is the beneficiary. That's three people to a policy. What that would mean most likely is that when he dies, and that death benefit gets paid to the spouse, that might be considered income taxable as a distribution from the company. And that isn't what they intended to do to start with. Life insurance is rarely tax deductible, to be very clear. And so the rule to follow is the owner should also be the beneficiary. If you just think about that. So whenever you see three parties to a contract, different owner, insured, and Benny, a red flag or yellow flag should go up. But that's the Goodman rule, to be clear. And since there's no more questions in queue, I will answer the other thing that was on that page regarding business owners. And again, this is an area where we shine. I've worked with a lot of high net worth individuals and business owners, and there's a lot more to their insurance than everyday people, right? And so it gets more involved with tax, ownership, legalities, and such. But I mentioned the EOLI laws, employer-owned life insurance rules. And this is something that I consistently find in reviewing business owner policies. They bought a policy years ago. They never complied with the EOLI. And the long and short of it, this was the foray into the government starting to tax certain life insurance situations. So if you don't document, disclose, and annually report, I should say, that your company owns a policy on you or your company owns policies on other people, then that policy could be deemed income taxable when somebody dies. So we are very conscientious because I do CYA around here all the time. Um, uh, we uh, excuse me, we know to make sure that we get the document and disclosures and provide to the usually the CFO or the owners. The 8925 happens to be the tax form. We share a copy of that with them so that they know. This is a good question. So life insurance is long-term contract. Somebody's asking, what's our continuity plan? Right now, I continue to seek another person to have continuity in my business. I'm not going anywhere for 10 to 15 years easily. I'm the busybody who I don't know what I would do with all that free time. So I like what I do and staying around. But I've went through a few people in the last few years trying to scale up. So we do have continuity for you. But this is why we deliver a baseline kit to everybody, so that when we work with your client, you know exactly what was placed. You have a copy of the policy, you have a copy of the source illustration, not just a spreadsheet, but the details in that source illustration and an IIC summary. So, every carrier has their own service center as well. But if again, everybody wants to be in your business with assets under management or comprehensive planning and such, fewer and fewer want to be in the insurance business. So there's your answer to continuity. If you know somebody who wants to be in it, let us know. So somebody, can you comment on a small business under 20 employees offering group insurance as an indirect way to get extra coverage for poor health owner? That is a strategy that we've sometimes commented or suggested to people. You're hitting on I have the ability, the type of group stuff that I get involved with is with executives and a certain level of the company and above. We might be doing a deferred compensation arrangement or just extra perks or whatever, but I have the ability with some carriers to do guaranteed issue life insurance. But I generally need 20 lives to start having that conversation. But for the person who wrote this question, I'm happy to talk to you a little bit further to see if there's anything else we might do, including screening the client's health. So I don't, sometimes people are a decline, other times they have one foot in the grave and one on a banana peel, and those aren't ones that are going to be approvable. But, I don't. a lot of people have conditions or diseases thinking that they're uninsurable. We do a thorough thing and we find them coverage. So I'm happy to double check that if you want, or give a second opinion. So we are at the hour. I thank you for your time. I point out that our presentation's coming up in next month on long-term care on 3/19 and on 4/16 on disability. Wish you a great rest of your day, and we will keep in touch. Thank you again for your time.